Hello, fellow investors. I hope you're all having a wonderful day. This is the final episode I'll be uploading that breaks down how to read the three main financial statements that investors look at when determining whether or not a company is worth investing in. If you haven't checked out my previous videos, I highly recommend you check them out. I'll be linking both of them in the description below. In this video, I'll be diving into the cash flow statement and using Foot Locker's cash flow statement as an example. The cash flow statement tells us how much cash the business produced during a specific period. Unlike the income statement, which only records expenses after they directly benefit the business, cash flow statements record any and all transactions that occur during a specific period. For example, let's say a company paid all of their staff their yearly salary all at once. It would be recorded in one quarter in the cash flow statement, but spread out over many quarters in the income statement. So there are three main sections to a cash flow sheet that we typically see that detail what the cash use is actually allocated for. These sections consist of cash provided by operating activities, investing activities, and financial activities. Let's go over the operating activities section first. This part mainly focuses on short-term assets and liabilities that the company is providing insight on. Typically, this includes the cash flow of normal operations of the business, such as a purchase or sale of inventory, advertising, as well as changes in how much the company owes or is owed. The company must be operating cash flow positive. This means the company is bringing in more money than they are spending. If they can't achieve this, they will need to take on more and more debt in order to survive. In Foot Locker's case, we see that they had just under $700 million of net cash from operating income, which has been pretty stagnant over the past few years. Underneath, we have net cash provided by investing activities. This talks about cash that is used or produced by long-term investments. The first section we see is capital expenditures, also known as CapEx. This is seen as investments in long-term physical assets such as buildings and equipment to grow the business. The second section we see is the purchase and sale of other investments. This can be any other investment in a long-term asset, usually an intangible asset such as research and development in Foot Locker's case. This section doesn't need to be positive, and in Foot Locker's case it actually isn't. The whole point of this section is for a business to invest in long-term assets, and therefore we won't need to see a return in a short period of time. The next section is called financing activities. Now this covers long-term debt and equity. More specifically, this shows all of the cash flows related to paying down or taking on more debt, issuing or buying back shares, as well as paying dividends. Foot Locker has spent a lot of money in financing, which is good because they're paying a dividend and buying back shares constantly. We see they spent $500 million under financing activities to pay out some of the profits to shareholders as well as to buy back their stock, which has been undervalued for quite some time now and has been proven to be the best time to do share buybacks. Lastly, we have free cash flow, which represents all the cash the business generates through normal operations. Free cash flow is calculated by taking operating cash flow and subtracting it by capital expenditures, also known as CapEx. We can see in Foot Locker's case, they have pretty stagnant free cash flow that's below net income. Of course, I'd like free cash flow to be growing, but the fact that it's lower than net income and mirrors net income growth is generally a good sign. Let's check back to the financing section now that we've seen free cash flow. We need to make sure that the company isn't taking on large amounts of debt while struggling to keep positive free cash flow. An example of a company that does have positive EPS but negative free cash flow is Netflix. Of course, the company has the potential to be free cash flow positive one day, but as of right now, the company is taking on debt in order to buy streaming assets. This, of course, is not sustainable until they generate positive cash, and I personally would stay away from that investment. Of course, in Foot Locker's case, they have a minimal amount of debt and are not taking on much debt in order to raise their free cash flow. In addition, they also are paying out quite a bit of their profits and buying back a lot of their shares, which is a very, very good sign because it means they don't have much debt and are not concerned about paying back that debt anytime soon. Alright, so hope you guys enjoyed watching this video as well as previous videos in the series. And if you stayed until the end and this helped you out in learning about financial statements and how to read them, please smash that like button, go down to the comment section, let me know what kind of videos you'd like to see next, and please feel free to sub if you enjoyed. Have a wonderful day.